The Dubai Annual Market Update report by global real estate advisor CBRE has revealed that the residential sector experienced further declines during Q4 2015, with sustained pressure on the transactional market reflected in the 4% drop in sales rates and the lower sales volumes. As revealed during a press conference today, average residential sales rates have fallen 16% and 14% year-on-year for apartments and villas respectively, while overall unit transactions declined by 33% year-on-year. The residential sector is expected to see further sales price deflation in coming months as supply levels gradually pick up, resulting in further falls for both rentals and sales values. Approximately 48,000 units are expected to be delivered between 2016 and 18. Matthew Green, Head of Research and Consultancy UAE at CBRE Middle East, said, with the actual delivery of units falling short of anticipated supply levels, the occupier market has held up comparatively well, particularly for more affordable locations such as Jumeirah Village Circle, Dubai Sports City and Dubai Land residences, which all achieved rental growth. Commenting on the commercial office market for 2015, Green said the sector has remained steady despite the emergence of more challenging economic conditions in the region amidst a period of lower oil pricing.
We've seen a fragmented real estate market with the different sectors performing somewhat independently from one another. We've seen a very resilient commercial office market with a real increase in pre-leasing activity recorded over the course of 2015. In terms of residential, we've seen the leasing component of that market again remain pretty steady, 0% change in overall rates over the course of 2015. However, the transactional market has definitely seen some downside. We've seen a 16% decline in apartment rates during the year and a 14% decline in villa sales rates as well. So definitely some more deflationary pressures existing within the residential market. Again, I think we're going to see a continuation of some of the trends which we've seen so far this year as well. We're going to see the residential sector have further deflation in terms of sales pricing, but we do expect the leasing component to hold up. For offices, again, we expect to see further consolidations within the commercial sector, driven by the availability of more good quality Grade A assets in upcoming developments.
CBRE's Dubai Annual Market Update report also revealed that Dubai's hospitality sector has proven to be very resilient in the face of more challenging economic conditions locally and globally. During the first 9 months of 2015, the Emirate welcomed 10.5 million guests as compared to 9.6 million during the same period in 2014, registering around 9% growth. Increasing competition and a strong US dollar are likely to maintain deflationary pressures on ADRs in the short to medium term. However, occupancy rates are expected to fare better amidst strong visitor growth. Approximately 22,000 rooms are expected to be delivered between 2016 and 18 to cater to this expected growth. Supply in Dubai's retail sector expanded by around 8% during 2015, with the opening of a number of notable retail facilities. And despite the rise in supply, occupancy rates within the major shopping centres remain exceptionally high, running at close to 100%. With the demand outstripping supply across the retail market, vacancy rates across major malls in the Emirate is less than 2%. An additional supply of 556,000 square meters is in the pipeline between 2016 and 18. With Dubai continuing to attract a rising number of tourists, the retail sector is expected to maintain current performance. However, there are some potential headwinds to consider, specifically the US dollar strength, which could have an impact on retail sales.
We've seen the hospitality market, one of the key pillars of Dubai's economy, also hold up pretty well, with occupancies only down around about 1% from last year. And whilst there was some pressure on ADRs, I think the market still looks pretty healthy. We expect to see continued growth in retail, again, another key component of Dubai's economy, and I think another good year is expected for that. For hospitality, again, we expect to see sustained deflation of ADR rates over the course of 2016, driven by new supply, potentially over 6,000-7,000 units going to come into the market over the course of the next 12 months. Add to that the impact of the dollar strength, and I think we're certainly in an environment where ADRs are going to remain under pressure.
Sharjah's residential property market is starting to show signs of softening at the end of 2015. However, according to real estate consultancy firm Clutton's, this is not holding back new communities, which are continuing to emerge as the population and development spread further north. According to Clutton's Sharjah 2015-16 winter property market snapshot, residential rents during Q3 2015 stagnated and recorded a marginal 0.3% increase, while year-on-year rents now stand at 1.6% below this time last year. This is the first time in over 2 years that average annual residential lease rates have contracted, but demand still remains for high-quality stock and gated community living. The report highlights that new communities and gated villas have continued to outperform the wider residential market, particularly apartments, with rents rising by 4.1% in the first 9 months of 2015. The report highlights that the popularity of gated community living is in part due to developers focusing on this segment of the market, with the latest scheme to emerge being the 20 billion dirham Sharjah waterfront city, where 1,500 villas are planned. The government is focused on diversification and also aligning developments to its master plan of shifting the industrial areas out of the city and further north.